Welcome to this explainer. Look, if you've ever watched the stock market open and felt like it was just a chaotic, unpredictable mess of price action, you are definitely not alone. But today, we're going to break down a highly structured, super high win rate day trading strategy. We're diving into a very specific intraday idea called the 3-minute opening range breakout. We're going to see exactly how to turn that crazy early morning volatility into a systematic, repeatable playbook.
Think about that opening bell for a second. Those first few minutes of the stock market, it's basically a gladiator arena. You've got institutional orders flooding in, overnight news getting priced in, retail traders scrambling all over the place. And well, unless you have a systematic playbook to navigate it, it is incredibly easy to get chopped up and lose your capital fast. The strategy we're breaking down today is designed specifically to tame that chaos. It's really all about finding clarity inside the noise.
Okay, so here's our tactical game plan. We'll start with the core 3-minute ORB strategy. Set our timing boundaries, walk through the exact buy and sell setups, and then finish up with the golden rules of trading.
Part 1. The 3-minute ORB strategy, a high win rate setup for liquid markets. Let's establish the battlefield where this tactic actually thrives.
So what exactly is it? An opening range breakout, or ORB, is a strategy purpose-built to capture intraday momentum. The whole foundation of this idea is just waiting. You wait for the market to reveal its hand early in the session, and then you ride that initial burst of energy. Here's the core mechanism. We're looking at the absolute high and low of the first 15 minutes of the trading day. But, and this is a really crucial detail, we execute our trades using a smaller 3-minute time frame. Basically, we let the 15-minute chart build the walls of our arena, and we use the 3-minute chart to actually pull the trigger when the price breaks out of those walls. We are waiting for a 3-minute candle to definitively close outside of that opening range.
Now, a quick caveat, you absolutely cannot use this strategy on just any random stock. It works best in highly liquid environments. We're talking about major, high-volume stocks or indices like the Nifty 50 or Nifty Bank. You know why liquidity? Well, because when a breakout happens, it happens incredibly fast. You need a massive amount of buyers and sellers already in the market to ensure your orders get filled smoothly without suffering massive slippage. This strategy feeds on volume and momentum, so we only hunt where the big volume lives.
Moving on to Section 2, setting the boundaries, because with this playbook, timing is everything.
This timeline lays out your entire morning. When the market opens, you do absolutely nothing. You just wait and observe. For those first 15 minutes, your only job is to sit on your hands. I know the FOMO can be strong, but you just identify and mark the high and the low of that period. That is your opening range. Right after that, we enter the action window. From 9:20 a.m. to 11 a.m., that is when you are actively hunting for trades, because that's when morning momentum is peaking. But once the clock strikes 11 a.m., you cease using this strategy entirely. Early momentum usually dries up by mid-morning, and the market tends to settle into a choppy, sideways mess. If you try forcing an opening range breakout at noon, honestly, you're just going to get stopped out.
All right, Section 3, executing the buy setup, going on the offensive. Now that our boundaries are clear, let's look at how to actually execute a long trade.
We've boiled this down to a strict 4-step process. Step 1, you mark that 15-minute range on your chart. Step 2, patience. You switch over to your 3-minute chart and you wait for a definitive close above the high. And I mean a close. A wick poking through absolutely doesn't count. Step 3, check your volume. The volume on that breakout candle needs to be noticeably higher than the previous candles. That confirms real money is actually pushing the price up. And finally, step 4, the entry. You can enter right on that breakout, or if you want to play it a little safer, wait for a small pullback to retest that level before it heads higher. These strict steps keep you from jumping the gun before genuine momentum is confirmed.
Okay, so once you're in, you need to know when to take your profits, right? The target for this strategy is a minimum 1-to-2 risk-reward ratio. That simply means if you're risking $50 on the trade, your target is to make 100. Alternatively, you can just aim for the next major technical resistance level on your chart. Why this specific ratio? Well, mathematically, even if you only win half of your trades, a 1-to-2 ratio ensures you're still coming out highly profitable over the long run.
But let's be real, not every breakout succeeds. Fakeouts happen all the time. The price pops above your line and then violently reverses. To protect against that, you need a hard defensive measure. Your stop loss must be anchored strictly below the low of that specific 3-minute breakout candle. If the price falls back below the very candle that sparked the breakout in the first place, the momentum has failed. The setup is invalidated. You need to exit immediately. Don't hope it turns around, just get out.
Section 4, executing the sell setup. The mirror image. So what if the market drops at the open? If the market is breaking down, we just follow the exact same logic flipped upside down. Assuming you have your 15-minute range marked, step 1 is waiting for a 3-minute candle to definitively close below the morning support line. Step 2, glance down and confirm that the selling volume is increasing. We want heavy participation in the sell-off. And step 3, you enter short on the breakdown or on a small retracement back up to the line for a retest.
It's really a perfectly symmetrical system. Look at them side by side. Buy setup, target is resistance, and the stop loss goes below the breakout candle. Sell setup, you flip it. Target the next major support level, maintaining that 1 to 2 risk-reward ratio, and tuck your stop loss safely just above the high of the breakdown candle. The market's direction honestly doesn't matter. What matters is your flawless execution of the system.
Which brings us to Section 5, the golden rules of trading. These are the defensive protocols that will actually keep you alive in the markets.
Look, these are absolute non-negotiables. First, trade only after the first 15 minutes. The urge to jump in at 9:02 a.m. is strong, I know, but you have to let the range establish itself. Second, take only 1 to 2 quality trades per day. If your first trade hits the target, you're done. Enjoy your day. If you take 2 trades and they both hit your stop loss, you are done for the day. Close the laptop. Overtrading is literally the worst enemy of a day trader. And third, avoid trading during sideways markets. If the price is just chopping around inside your 15-minute range, doing a whole lot of nothing, stay out. This strategy requires directional momentum. But perhaps the single most important metric in this entire explainer is right here. This strategy completely relies on you risking only 1% of your total capital on any single trade. It doesn't matter how perfect the setup looks, it doesn't matter how high the volume is. You calculate your position size so that if your stop loss gets hit, you only lose 1% of your account. Think about that. You could literally lose 20 trades in a row and still have 80% of your capital left to fight another day. It completely takes the emotion out of the game.
We've covered the time frame, the targets, the stop losses, and the risk management. This strategy gives you the logical parameters to succeed, and it's incredibly straightforward, which leaves you with one final question to answer before the opening bell rings tomorrow. The setup is simple, but do you have the discipline to actually follow the rules? Do you have the patience to sit out those first 15 minutes and the strict mindset to just walk away after 2 trades? Because at the end of the day, it's not the market you're trying to master, it's yourself. So will tomorrow morning be chaos, or will it be calculated? Thanks for joining me on this explainer, and I'll catch you on the next one.